Hello and welcome to the Help My Wealth podcast, Money Rules or Money Rules. Here at Help My Wealth, we are all about empowering financial success in our community of listeners. We hope you find today's topic both informative and helpful. Welcome back to the Help My Wealth podcast. At Help My Wealth, we're all about empowering your financial journey, and today we're going to do that through our topical discussion. I have with me Hamish Ferguson and David Lennox. Thank you guys for coming.
Thank you, Steve.
Look, today I really wanted to talk about property and that property investment journey. I mean, myself, I'm a buyer's agent and I specialise in property investments, so that's sort of an area that is of interest to me and that I like talking about. What are your thoughts, Dave? I mean, you've come from that chartered accountant background of 33 years. You've been a mortgage broker for 23 years. So you've got, a wealth of experience, from that lending side. And Hamish, from a financial planning point of view, you've got that wealth experience from going, I've got all these different asset classes that I can suggest to clients to move forward in. So I thought, while I had you both here today, that'd be a good area to discuss with the three of us.
Yeah, look forward to it.
Fantastic.
Yeah. So are there any questions in particular that you would want to bring up in regards to property or any topics that you think are relevant currently now?
Well, I'm very happy, sorry to interrupt, to talk about the structure of an investment loan. Now, in our sort of history, we've really become specialists of people that want to build a property portfolio and how finance plays a massive role in that. So we're very experienced at dealing with sort of aspirational portfolio builders, if that's the terminology. So that's the area I want to talk about, is people who are looking to go on that journey and how they finance it.
And Hamish?
Yeah, well, I guess, property has typically been an area that most financial advisors have struggled to speak into, right? So, but, being like Dave and having a mortgage broking side to the business as well, I've really tried hard to bring that into the conversation, to be able to talk to people about how does property fit into all of the other questions somebody might have when they're trying to develop an investment strategy.
Yeah. And for myself, I think I'd like to talk about cycles. I think at the moment the big question is this now a good time to invest in property, or is it better not to? So I think that'd be a good thing to actually talk about at this current time. But Dave, I'd actually be interested in starting with your topic. So, tell us, in regards to yourself, has much changed between, last year going through COVID, high interest rates now, when it comes to property investment and actually creating those loans and products for people?
There's no real change to how we would structure investment lending and how we would do that. Obviously, when rates go up, people's borrowing capacity does slip down a little bit, unless, of course, they've had a giant jump in their income.
Yes.
People's borrowing capacity has gone down a little bit, but in terms of the principles of how we structure investment lending, that hasn't changed.
And is it the same for, say, someone coming for a first home buyer compared to someone, say, coming for their first time investment or their second time investment? Has it changed at all for those different groups, or is it pretty much the same? Borrowing capacity, and the bank is looking at it as the same? Correct.
Look, we tend to follow some fairly simple principles in terms of whether we're structuring an investment loan or a home loan. So not a lot of that has changed, but it's all about really digging into people's longer term objectives. So, for example, with a home loan, people tend to save a deposit, whether that's over 1 or 2 or 3 years, and get assistance maybe from some parents, things like that. So that journey of the first home purchase is very different to the second home purchase. So in the example I'm talking about here, it's someone who's bought a first home and maybe 2 or 3 years later, they're starting to think about building a portfolio, and they think they need to pretty much run the same race, which is to rebuild their cash reserves as a deposit for their second property. And that's certainly not the case. 99% of the loans we have done for people buying their second or third property has been done without any cash injection at all. It's all about how you use the equity, how you structure the loans, how you maximise tax benefits, those sorts of things. So the myth that we tend to dispel is that people need to save cash reserves to buy their second property. That's not the case. And when people find that out and see how it works, their eyes light up. Before you know it, they're getting pre-approved for an investment loan.
Yeah, it's funny you say that because I would say that's one of the first myths that I have to even dispel is that people come to me and say, I want to get investment property as a buyer's agent, and they say, but I haven't got my cash, like I need more cash. And that's the first I say to them, well, actually, you probably don't need as much cash as you think. Have you spoken to a professional? You know, and then I can send them your way or someone else's way for them to actually, you know, go that direction and start down that path. But I mean, look, let's give some examples for someone. Let's say someone wanted to buy let's say a $700,000 investment property. You know, what are they looking at and requiring for the deposit for that, and how do they actually get it out of their home? How does that sort of work?
Okay, now without a whiteboard or something to demonstrate, let's say that I'm thinking of the typical home purchase that might have bought their first property 3 or 4 or 5 years ago.
Yep.
So let's say they spent $800 on that, and that's now worth $1 million, and they might have a $500,000 mortgage on their home or less, something like that. So they want to buy something for $700,000. We're going to borrow 105% of that property.
Yep.
So that they don't put any of their own cash, 105%.
And what's the 5% cover?
Stamp duties is the main one. So, and that's very much a rule of thumb. So 105, that's the maths we do. So we'll do 20% or 25% against their home.
Yes.
So 25% of 700. Help me out.
175.
175 against their home, and then 80% against the investment property. Right. All of that is investment lending. Some of it is secured by the home. That doesn't mean it's not tax deductible debt. I'm not giving tax advice, but that is definitely a very strong principle. The deductibility of a loan is not related to what it's secured by. It's what the funds are used for. So even if the loan was secured by this piece of paper, like if a bank would give me a loan secured by this piece of paper and I spent it on an investment property, then that lending, because that asset I'm buying is generating assessable income, then that interest is tax deductible. So that's the general principle. And when people understand how much of the investment property cost is sort of deductible in terms of the tax man helps, they're very surprised in terms of how little of their monthly cash flow they need to actually allocate to owning that second property.
Yes. And so I guess, you know, from your point of view, and Hamish as a financial advisor, please weigh in here as well. So someone needs to have, you know, at least that 175 in equity in their home. But most of the time you guys talk about requiring a buffer. Not that the banks require the buffer, but from your point of view, wanting to look after your client and do the right thing by your client, you're saying this is how much I would like you to have in there before we, you know, go ahead with a loan. What is your rule of thumb in regards to requiring buffers for clients or suggesting buffers for clients?
I mean, when it comes to property, I guess it's having that long-term surplus in cash flow. So I've typically said to people, look, it's a good idea to know that if you buy an investment property, it'll probably cost you about $150 a week. All right. So now that can depend, and I'm usually very clear with that. If it's an older style property that needs a lot of maintenance, it might be more than that. If it's a newer property or a dual key or some of these types of investments that have been done recently that are a little bit stronger on the yield point of view, then it might be significantly less than that for the first 5 years at least. But when you build into the long term things like hot water systems blowing up, needing new carpet, things like that, that $150 a week as a rough rule of thumb is just usually where I'll start. Now, I'll be honest, with interest rates the way they are at the moment, I've probably been trying to sort of gauge that. That might be a little bit out of date, that figure. And this is where it's really important that in those initial conversations, you can't get into that because you haven't even found the property yet.
That's right.
All right. So, but it's more just starting that education and understanding for the person to go, all right, well, wait a second. When I see all of these ads talking about cash flow property, I just have to be careful with that because it's not always the case. All right. Yes. So, yeah. Does that answer the question?
Yeah, totally.
Would you agree with that?
Totally.
Yeah. So the idea being is that you've got yourself, some money in your house that's equity that you can borrow against, and then you've got yourself some cash reserves that can be used there to pay for extras, and if the mortgage needs to be paid out of that, if the rent's not covering it all, and so forth. And once you've got those two things balanced, then you're ready to come and talk to a professional and move ahead.
And it's not just $150 a week today, or whatever that figure is that we agree on. It's wait a second, you're going to buy property, all right, and correct me if I'm wrong, but I would label property as something that you should be buying with probably a 10-year time horizon. Right?
Yes.
So, if you're a young couple and you haven't even started having kids or anything like that, well, you've got to think through those things and go, wait a second, can I maintain that level of contribution for a significant length of time? We're not just talking 3 to 6 months here. So, they might want to upgrade their home. That might upset the apple cart a little bit. There's a whole range of things that you've got to think through just to make sure that the client's expectations are set right.
So, Hamish, in regards to your question, what were you wanting to bring up today?
Yeah, well, I think, I must admit, if you said to me, is there any time that's not the right time to invest? I would say no. We've got to take that statement with a grain of salt, all right? So even right now, you look at it, places like Sydney and Melbourne, and I think Brisbane as well, the property prices might be coming back a bit. I think there's a famous investor that once said that the time to buy is when everyone's selling and the time to sell is when everyone's buying. So you've got to go against that inertia sometimes and say, well, wait a second, if I make the assumption there's always opportunities out there, then there's never a bad time to buy, all right? So it's more just a matter of then saying, well, what do I need to be prepared for if I'm going to invest at this current point in time? And that's, to me, where there's probably two things that as financial advisors we think about a lot. One is risk profiling, which I'll explain a little bit more in a second. And the second one is our time frame or the horizon that we've got, which is sort of related. So, the concept of risk profiling is saying, are you the sort of person that can cope with what sort of bumps and bruises along the way can you cope with when it comes to investing? All right. And again, it'd be lovely to have a whiteboard at this point, but, we typically think of, a stock market graph or things where we see this almost roller coaster ride where whatever the asset we're buying can go up and down over time. All right. And so the growth orientated investor or the person that's comfortable with borrowing to invest usually doesn't get worked up with the daily movements or whatever happens with that asset. So that could be, the number of times if you've got your super, you jump on and have a look at what the balance is. If you're the sort of person that jumps on and looks at it daily, all right, then you've got to be careful that you jump into an investment at this point in time because it's probably going to really stress you out. And the problem with that stress is that it's much more likely that if you have a bit of a dip along the way or if something goes wrong, you'll jump out when you shouldn't. All right. So whereas the person that has more that growth orientated, that long-term horizon that says, I'm happy just to do it, invest the money, comfortable with that $150 a week, Hamish, I'm not even going to look at it, and they can actually genuinely do that, then they're the sort of person that probably should jump in now and say, well, what opportunities are out there, right, if I've worked through that process of establishing that I'm ready. All right. So that risk profiling, is quite important to think about for the individual.
I'll jump in with a little bit with the question that I was going to bring forward, which is that idea of cycles, because you've brought that up. And I think that's really important. People always say that, it is now a good time to invest in property. And from a buyer's agent point of view, the answer is always yes. The question is where. I probably wouldn't be buying in Sydney or Melbourne right now. It's probably not an area that I think is going to, be good in the short term. And when someone comes to you with, if we use that example of $700,000, that's what I've got, that's what the bank can loan me. It's about going, where's the best bang for your buck? You could spend that in Sydney, you could spend that in Melbourne, or you could spend that somewhere else. And let's look around Australia and see what suburbs, what cities, what areas are going to actually, be the most effective for you and is going to actually give you that high yield, and that high equity growth long term.
So here's an example that I usually run past clients that sort of, I don't know, put a little bit of question to that sort of philosophy. All right. So let's say you live in, and we'll use New South Wales as an example. You live in Hornsby. All right. So you're on the cusp, and you've got, and you sit down with a property person. The property person says, okay, so we could find you something, on the Central Coast, and it might cost you $800, and you can get a loan for $800 at the moment, or you can buy in Perth. All right, and I'm just purely picking Perth at the moment because it's the furthest distance away in Australia. All right, so not because it's the right place to buy or anything like that. All right, that'd be your job to do, Steve. So, let's say we looked at all the data. All right, and it said that if you bought on the Central Coast tomorrow, all right, so all the data is saying the best you're probably going to get is probably 5.5% if you hold on to the property for a 10-year basis. All right, we could go to Perth, right, and Perth is looking all the up and up, all the right metrics are in place, and we reckon that the numbers are showing probably a 7 to 8% return over the next 10 years. All right, so the question is, what would you go for? All right, so, and it's surprising how many people would say, I'll go to the Central Coast.
Yeah. 100%.
All right. So, and so that where concept, it's this mix between, what the person is comfortable with.
Yes.
Because if you pick outside their comfort zone, there's that higher chance that if the market doesn't do what they want, they'll get 4 years down the track and go sell.
Yeah.
All right. Because I don't understand Perth, and there's all of this, vagaries around that area or whatever. Whereas if you'd just gone for what I know, all right, and picked the Central Coast, all right, so they probably would have still been holding onto the property because it's something they would have been more comfortable with.
Yeah.
So it's getting this balance between what the individual is comfortable with and what the science shows is part of that journey of getting the property right.
Because look, no one has a crystal ball. No one can tell you this suburb or this city is going to be the best one in 5 or 10 years' time. All we can do is take the data, take the metrics and go, look, as far as we can see from the data we've got today, this is where you're going to get the most effective bang for your buck, But I would agree with you. It's amazing how often I've got to talk to someone and I've got to not talk them out, but suggest and talk around why they want to buy in the suburb next to them, or like you said, half an hour away from them or something like that. And it is very much about comfortability. It's very much about seeing the asset, being able to see it. And I said to someone one time, how often, do you think you'll drive past that asset? Oh, I don't know, maybe once a year. Okay, because you can't go there, without giving written warning and all the rest to the tenant. So it's not like you can just turn up and walk through the house and have a look in the backyard. So I said, okay, so once a year, and you're going to drive past. Yeah, so you're not going to go in and sneak around. Oh, no, I wouldn't do that. Right, so let's say you did do that once a year. How effective is that going to be to know whether it's rent's being paid, is there holes in the wall, is the grass being cut? I mean, it could be long when you drive past or short when you drive past it. It's not telling you too much. The person who really tells you how it's going on is your leasing agent. They're the ones that are going in there regularly. They're the ones you're paying to actually say, hey, Dave, everything's good. So the important choice here is not whether you want to buy half an hour away from you so you can drive past, but is the leasing agent you're getting an effective, good, right, ethical, leasing agent who's going to do the right thing by you.
And that sometimes can get tricky as well because, again, if we look locally, well, if my property manager's not doing a good job, right, it's really easy for me to drive around, pop into 3 or 4 different real estate agents, talk to people and all the rest of it. But then, if I buy interstate, all of a sudden I'm relying on a different thing. Yeah, I can ring all of these people, but it's a lot harder for me to use my existing network and professionals and things like that. So I'm not saying don't buy interstate. What I'm saying is that the education and the understanding that you go through to help somebody understand this is what this journey looks like.
Yeah.
All right. So I think it's just really important.
I would say 85, 90% of my clients have to go through that journey before they're willing to buy interstate. There's very few of my clients that go, hey, can we please buy interstate? I want to, wherever my $700,000 is going to best work, go for it. So there's always that journey of actually educating, talking through the issues and seeing, because look, in the end, if they want to buy around the corner, we can buy around the corner. It's just not going to be as effective for them. That's why I always say to them, look, understand, this isn't me going, don't buy here, don't buy there. I'm getting the same money wherever we buy. I'm just trying to do the best thing by you.
Look, we've had circumstances, and I declare a conflict here because part of the Vision Group is Vision Property Investment, which does help people locate. So I declare a conflict. But the reason we've got into that is we did find a trend that people were allocating more of their time to working out what computer to buy, what car to buy, rather than like when they had wanted to enter the property investment, they might have spent a couple of hours, searching on the internet, or they might have got caught up at a property investment seminar, and they have made a decision within hours of what to spend $600,000 or $700,000 on. A high density 1-bedroom unit out at Parramatta, or I'm not talking against Parramatta, I'm just saying that.
As an example.
So my business partner Matt, and Hamish, you're probably the same. When people turned up saying, I want to buy this investment property, Matt just started asking the question, why? What is it? And that conversation and researching the psychology that you're referring to, Hamish, and you, Steve, led to all sorts of areas as to what it was that drove people to make such a huge decision, right? Now, if they did do that, property's been so robust in most locations is that people have had not such a bad result. Now, some people have had bad results, but certainly now is the time over the last 5 years to sort of get those decisions right. I mean, it's always important to get that decision right, but people have been buffered by the overall generic property market growth. But in terms of one of the psychology points you bring up in terms of location and people getting used to interstate is what Matt found. Of course, growth and yield very important, and yield has certainly become more important, is that people wanted to do something a little bit more interesting. So if they've got $700,000, they can invest in Bondi in a rundown 1-bedroom unit out the back of the beach in an old apartment block, etc., and actually 700 wouldn't get you that. People might.
I was thinking in my head, where is that? I want to find that one.
But there is a theory in investment lending world and tax deduction world is to get something new, provide some advantages, not necessarily the thing to do, but it is generically better to buy something new, less maintenance, more tax deductions, etc., and people are interested in that. So getting a new apartment in Sydney in those areas is way more. So people were more interested in building their own thing, right? Building a house or a duoloc or a duplex, whether it's in Queensland or somewhere. You're just doing something a little bit more interesting, and people psychologically felt as though they were getting more bang for their buck because they're building a house or doing something less density, less. Anyway, we have found people very open to building their own thing at those price brackets because we found people coming to us with a budget of 600,000, 700,000, 800,000 really didn't know what to do. So they just went on the internet and did the first thing.
And I always say it's about good, better and best. You could buy a good property by yourself and over time, hopefully it does well. But the question comes is, could you have got a better or best property? In the end, that's the money you have. Once you spend that, that's the asset you're committed to. You know what I mean? So take that little bit of time and work out which is the best way to go. Now, Hamish, I interrupted you with my cycle. So where were you up to with the question that you were answering?
Look, so if we took the risk profiling aspect to this and said, okay, the person's suitable to invest, right? So, and part of that is also about the borrowing aspect to it. Is borrowing to invest a good thing for that person or not? So then the second part of that journey is then saying, well, let's talk about the different asset classes and determine which one we think is more suitable for you. All right. So, so when we think about that, normally what I say to people is, look, whether you want to talk about property, shares, business, whatever it happens to be, they're all tools. All right. They're all tools that we employ to get us to a destination. Right. So, and so we have to work out which tool, or which tools the person needs. And I actually think that both of them have their place in somebody's investment strategy, right? But there's going to be some seasons of life where, property may be more suitable because of where they're at, right? And there's going to be other times where, it might be that they need to look at, shares or managed funds or things like that, mainly because the shares can be a lot more flexible. So property can be, it's a little bit more rigid in terms of once you do it, you're in. So, and it's a long-term game and you can't take part of it out or anything like that, or it's very hard to. So it's just trying to get into that. Okay, do you understand what you're getting into and what the personalities of the different investments are? I like what you talk about in terms of Dave saying, our clients tended to want to do something a little bit different, because I do tend to find that no matter, how people want to invest, is that there is this, to an extent, there has to be a level of, I don't know if this is the right word, but almost enjoyment that comes out of it. There's a satisfaction, right? Satisfaction might come from, well, it's going up in value, all right? So, but it also could come from, somebody investing and want to be investing in ethically, all right? So, in terms of shares and managed funds, right? It could be that, I remember talking to a client recently that actually deliberately wanted to get into property. Well, if they got into property, they wanted to do it at affordable renting. All right, because it had a better feel-good aspect to it, that they didn't want to be seen to be the rich landlord, milking the poor person for every dollar they had. So actually investing in something that actually had lower rents was more attractive to them. So they're all things that can actually add to the value of what the person's doing as well, because there's that contribution to society almost and personal enjoyment and not just the return on investment. But sometimes that can be a tricky part thing to unpack as well, and really understand the motives for why somebody wants to invest.
And look, that's really important for me when I talk to my clients as well, because, you get someone come in and say, oh, I want to get an older house that I'm going to do up. I'm going to put a granny flat in the backyard, or I'm going to subdivide, or I'm going to do something with it. The first question you've got to say is, how willing are you to do it up? It's going to take a while. There's a lot of work here. Are you a handy person? If you're not, are you willing to pay a lot of money for handy people to fix it up?
Are you talking about people that flip properties?
Yeah.
Do it up, and that's a very, very it's a very unique skill. It requires a lot of experience and
and it has to be the right time too.
It's got to be the right time, and the person has to have such a strong understanding of the cost of doing it up. That tends to be where, if they've got a short-term time frame, which most flippers, for want of a better word, have, and it's a completely reasonable strategy. It's just that you need to be really across how much it costs.
But even if you're buying it with a long-term view of holding on to it, I think some people don't. They buy an older house because that's what they can get into. Do you know what I mean? With the money they've got, and the renovation costs, the cost of actually doing it up and getting it to a point where it's going to be ready to be rented out properly and at a good price, can be quite extensive. So it's about saying to someone, is that a passion for you? Do you know, are you want to? Because if you're doing this for your passion, then great, go for it. If you want to get in there and fix it up and do whatever, great. But if you're doing it solely from a point of view of profit and long-term equity and gain, then it's more about numbers. It's about going, okay, what's going to be the most effective? Bring your accountant in. What's going to be most effective from an accounting point of view when it comes to tax and tax depreciation. Bring in your financial planner. What's going to be most effective from that point of view? Because sometimes people have these ideas, or they've heard stories. Oh, I know a guy who flipped it, or I know a guy who subdivided, or I know a guy who, and they did so well. And until you sit down and go, do you understand the cost of subdivision, how long it's going to take you, how hard it is to do? I'm not saying it's a bad option, but are you prepared for the extent of that?
Absolutely. Absolutely.
Yeah.
So Steve, talk to us about, you mentioned before about wanting to talk about the property cycle. So what's going on in your brain at the moment with December 2022, interest rates where they are, the way the property market's been performing over the last couple of years?
Yeah, so when you look at what the talking heads are saying, or the talking heads that I like to listen to, the ones that I feel are a bit better informed, and we look at where the data is at, it seems like, and that's always the case, I think if anyone tells you they know exactly what's going on, you've got to be a little bit wary of that person, because no one has a crystal ball as to where the future is going to head, particularly in regards to property. But we do have some good metrics, and we do have some good data around historical figures where things are at and where things are changing. So look, Sydney and Melbourne are definitely off the boil in regards to property, and every city and every suburb has a cycle. So if we look at that, it's about going, is Sydney a good place to buy? Well, it was a couple of years ago. It's a great place to buy. Is it a good place to buy now? Probably not. It's not where I'd put my money if I was buying it for myself or for my mum or someone else. And it's about looking at what the metrics are in that area, what the rent is compared to the costs of it is for doing it. We talked about, building new property and getting constructions. And Hamish, you mentioned some of these new ideas about like having dual locks and things like that, where actually it's a lower cost to provide two dwellings where you're getting two rents coming in. So it's a bit more stable. So we can do factors like that actually increase that yield compared to the cost that you've got. But you've also got factors like, for instance, up in Brisbane, there's been, especially from COVID, there's been, a large influx of people moving up there, both internally and externally. And you've got the Olympics coming in, so you've got lots of money. I think it's about $500,000 being spent in that southwest area of Brisbane, southwest area of Brisbane in regards to upgrading all the facilities. And so you look at things like that and you go, okay, what's happening there? That looks really good. And Brisbane's been excellent for the last, 2 years, 3 years. But again, we come to Brisbane and we look at, a situation where all of the larger building firms have gone bankrupt in the last couple of years. And in Brisbane, they're all insured, all the houses. So, of course, the insurance companies have turned around and said, I've got to get these built. Who wants to build them? And so every other company has taken that up. So you've got a situation there where it's not so much that Brisbane's a bad place. Who are you going to get to build your place? Do you know what I mean? There's just everyone's building all those, everyone's filled up. Plus registered land is hard to find there. And so we look at things like that. We look at vacancy rates. And as we do that, we're starting to look more and more towards Perth, as you mentioned, Hamish, before, and to a lesser degree Adelaide, but definitely Perth. Perth is more and more looking like that's the suburb, that's the next one that's on the boil, And again, when I say it looks like, because we're not looking for the suburb that is on the boil, that's the one that you should have bought in a year or two ago. Do you know what I mean? We're looking for the one that's heading that direction, and Perth definitely looks to be that area. So for my clients and for my partners and so forth, when we're looking at different areas, that's where we're looking at the moment.
So, thinking back to, I guess this whole, understand the area and things like that. Because when I think about Perth, I have seen some of that information, all right? So probably not to your level, but, one of the things that I sort of think about was, it must have been 10, 15 years ago now where, Perth was almost as expensive as Sydney.
Yeah.
All right. So,
yep.
And, there was talk of it becoming the most expensive capital city in Australia.
Yep.
Right. And of course, Perth's had a bit of a rotten time over the last sort of 10 to 15 years in terms of them what that journey is. So, and I'm not expecting you to necessarily go into a whole lot of detail here, but how do you get that grasp of that story and how it changes now to where it is? And because I think about it and go, well, wait a second, it's still a capital city, all right? It's still, a city where there's a lot of good things happening in there. All right. So, and there could be a lot of data that sort of suggests, differently to that as well. But is that something that goes through your mind when you're talking about areas like that?
Yeah. I mean, look, we're looking at things like employment statistics. We're looking at things like vacancy rates, things like that actually say to us, is that area doing well? Do you know? And you're right. Perth went through a cycle where it was getting higher and higher and higher, and people were getting paid a fortune from the mines, and that all changed. And now it's going back through a cycle where the vacancy rates are really low. It's hard to find a place in Perth. So again, the costs are starting to increase. You talk to people that go to Perth, and it's very rare to find someone that says they don't like Perth. Everyone says it's beautiful. It's just a long way away. But if you're the sort of person that's like, hey, I'm willing to relocate, and after COVID, obviously that's been the case because there is a lot of people relocating to Perth, and it's really becoming one of those satellite type things. I mean, you go to countries, like America or Europe or other places where a couple of hour flight to another city is not a huge thing. For us, that just seems like a lot. 4-hour flight, just, wow, it's too much. But that's going to change, and it's going to change as Perth gets bigger and bigger and bigger. And so what we're trying to take advantage of there is getting in while those suburbs are expanding. At the moment, someone said to me, Perth reminded them of Sydney back in the 70s and early 80s, where there was lots of areas that had to be filled out. And there was the employment and the population growth and so forth there to actually take that up. And that's what we're seeing in Perth at the moment. So low vacancy rates, good employment. The state itself is probably the most stable of all the states, when it comes to its budget and its surplus, and the way in which it's actually investing in infrastructure. I would say, I haven't had a look at it, but I think Perth is, if not the highest, one of the highest states investing in its own infrastructure. So when you start to see large infrastructure investments, low vacancy rates, good employment results, then that's a place you need to start looking at and taking note of.
And that's interesting in the sense that, so what you're talking here now is to bring in the science. So we look at the data, we look at, so you've talked about vacancy rates, you've talked about infrastructure, you've talked about migration, net migration. So they're all things that a good property investment person is looking at. Is that right?
Yeah. Plus, and that's the macro. That's looking at it large. Then we start going into micro and looking at things like, well, okay, what's the best suburb? Let's start talking to a few agents and saying to them, leasing agents, and saying, hey, if I could get you a house in a suburb, which suburb would you want me to get you a house in? It's not long before you talk to a few of those, you start to work out which of the suburbs they are desperate to have houses in. It's not long before you talk to them and say, look, the cost of rent, what would be your average person wanting to spend? What are they willing to spend? So it's not long before you can start to work out, you don't want to go above this rental, so you don't want to spend, $1 million buying a house because the rent would be too much. Do you know what I mean? So where is that sweet spot where that affordability line is for the average person to go, yes, I'm willing to pay that rent? We look at things like train lines and bus routes, and not just now, but in the future. And what's actually looking to be developed there, schools and shopping centres and different things like that, to actually say this actually from a macro and from a micro level is a good area, Yeah,
cool. Okay.
Just to challenge you on the Perth question, Steve.
Please.
People, in terms of things to really steer clear of with property investment decisions, one thing that comes to my mind is to steer clear of places which heavily rely on one sector of the economy. So, for example, myself, tourism hotspots, Cairns, Noosa, now, and Gladstone for mining, places that can go through big fluctuations of people in and people out. So Perth may have had a reputation over a period of time that it's heavily reliant on mining, which is one industry, but it's really a conglomeration of many different industries. What has Perth done, do you think, to sort of broaden its employment appeal and migration appeal, right? Not just people wanting to work in mines and stuff.
Yeah, Perth looks to be a city that's matured a lot. So it's gone from being very reliant on one industry, and it's now more and more becoming a city in its own right, where it has quite a few industries that are actually there. I don't think you can pull away from the idea that there is, a specific industry being mining that a lot of Perth infrastructure is built around, or, employment and so forth. But I think one of the interesting things with mining is that it seems to have gone through quite a bit of a shift, where it was quite heavily reliant on people and quite heavily reliant on manpower. And as we've seen over that last 5-10 year period where there was a large decrease in the amount of people working in Perth in the mines, although that's come back, it hasn't come back like it was before. So we can see here that mining has gone through its period where a lot of those mines have now been automised and have got that sort of technology and so forth in there, which is always hard when you have an industry that's going through flux and change for the people that are involved in that industry. But that hard change has occurred, it seems to be, and so now we've got a situation where those that are going back into the industry are going back into a much more stable environment. Plus, even though there is flux and change in the mining industry, it really is one of those industries that it's not going to slow down, is it? It's going to continue on.
So what do you tend to steer clear of, like in terms of locations and cities? Like, what do you...
Yeah, so for me, it's about looking for areas where you want to have some structure around how far things can spread. So, for instance, Sydney can't just keep spreading and spreading and spreading. It's got the parklands on either side of it, north and south, where you can't build onto it. It's got the Blue Mountains at the west, where you can't sort of go past, and so everything's sort of building in the middle there. Even with a city like Perth, it's about where the centre of the city is. It's about how far out from that. So the further you move out, the more situation you've got where it's getting further away. People are willing to pay less money because they've got to travel more. They're not willing to go out so far. So it's about getting that sweet spot between, being too far out. So sometimes you find geographical locations in a town are actually not good for that, because pretty much you can go 365 degrees, any direction you want to go. So you want to be a little bit careful of that. Towns again, or cities again, that are very reliant on a specific area or on a yearly cycle. So you mentioned Noosa and some of those touristy towns. If you want to purchase in that area, that's great. But you need to understand that there may well be a big change in your rental market from one month to the next. A lot of people like going with this whole idea of Airbnb, and there's always, great stories about Airbnb and people doing that. And there's nothing wrong with that being the strategy. But are you prepared to have that large income over the holiday period, smaller income outside of that,
Yeah.
But for me, looking at vacancy rates, looking at influx of population, looking at infrastructure, what's the government spending? If you start seeing the government putting in major roads, if you see the government upgrading hospitals, if you see the government doing things like that, that's a good indication of an area that they've already said over the next 20 to 30 years, we need to get some things sorted out here. I think a great example of that was actually in that southwestern area of Brisbane over the last 5 to 10 years, where they spent millions of dollars in the hospital. They spent millions of dollars getting all the infrastructure sorted out. They spent millions of dollars setting up industrial parks. And as soon as you start seeing that sort of money being spent, that's when you need to go, okay, that's an area that we need to be keeping a closer eye on, because the government's already started to see that as being an area that they have deemed in the future will be a key area. Does that answer that question?
Very good. Yeah.
Yeah, I guess, so, and what I like about this, is that, as a novice around property, I would say that, one of the benefits of city is just that supply-demand thing. There is such a limit to where the city can go that it surely has a positive impact on prices over time. Yes, there's that price, the purchase price that you've got to be able to borrow to get to that. But being able to pick somebody that can actually, work through those numbers and be able to say, well, here's what the information is telling us. I laugh at the fact that, I typically over the years, if people said to me, hey, Mish, here's $700,000 to invest in the stock market, and I just went, all right, let's just have a quick look. All right, 5 minutes later, bang, here's where we're going to go.
VHP in the banks.
Yeah, that's right. It just would have, people would just look at me really strange and say, what, you want to charge me money for that? Like, I could have done that myself. Yeah. Whereas that's what they do with property, it's a bit of domain or realestate.com and off they go, Whereas to actually hear this science starting to come out in terms of what it means to really analyse markets and different parts of Australia and see what's going on here, it's just good to hear.
Yeah.
Right? So, yeah.
I mean, look, the great thing with somewhere like Perth, for instance, is that it was still in a situation. You mentioned it with Bondi. To buy something near the beach, even a 1-bedroom terrible unit that you wouldn't want to put anybody in, is going to cost you, $1 million. Whereas, over in Perth, you can actually get quite close to the beach, not too far from the CBD, and still end up within that affordability line. So it's actually got a lot of room for growth there, which is great.
Just watch out for the big fish.
Yeah. Watch out for the big fish.
I was going to say crocodiles, but no, that's Northern Territory.
That's Northern Territory. That's another cycle, not yet.
Yeah. So
there's being close to water now, close to the sea. Growing up, and even now, it seems to be the place to want to buy and live. But with things that have happened, I'm getting the question more from people as to whether or not being close to the coast is as good a thing as it used to be, just with climate. And I'm not one way or the other, but certainly it might be harder to insure places that have sort of had some water run through it from a weather event. Have you seen any change in?
Look, I definitely am looking at that in regards to when we especially older houses that are established. We tend to find councils are already pre-thinking that much more than state and federal governments, because the federal government gets mixed up in the politics of that. Is there such a thing as large weather events or global warming or the rest? They can't make decisions because it changes their whole tact. Whereas local governments don't have to get caught up in that. Local governments have very clearly stated, this is our flood zones. You can't build here. If you want to build, right on the water, there's very different rules now compared to what there was 15 years ago. Local councils are not allowing people to just put their slab right down on the waterfront at the same level as you could back in 1990, So local councils are far ahead of us when it comes to things like that, and they're really thinking it through, because let's face it, they're the ones that are going to be stuck with it.
They probably get the first phone call, don't they?
They're going to get the first phone calls. They're the ones, and they're also the ones that have said, yes, you can build there, yes, you can do that.
Yeah.
So you're finding that they're making developers really build up the areas that they're actually building on. Whenever you go past an estate now, you always find it's being built up. If it's near water, they're doing much better when it comes to drainage. They're doing a much more robust situation in that, and we saw that in the floods in Brisbane. So a lot of the new estates didn't get affected by the floods in Brisbane like the older estates did, or the older houses did, because, in the last 10 years since those, rules have changed, the councils have made sure that they're future thinking what's going to happen, which is a good situation. So, Anything else you guys wanted to add to that journey, that property journey?
I have a question for Hamish, being a mortgage broker and a financial planner. So you're obviously, with your mortgage broking business, you have an interest in people buying property and investing in property, and that's how you get to be a mortgage broker. How do you balance out having the two hats when, in terms of how you deal with people? They may not even be a planning client. They might just be coming to you as a mortgage client, but how do you balance the two responsibilities?
Look, one of the first things I try and always say to people is, look, you got to ask me what hat I'm putting on. All right. So, and are you giving me permission to actually give you advice, or are you just wanting me to operate as a mortgage broker here? Now, that might come across like I'm trying to sort of almost, take a lack of responsibility or something. Shouldn't I always be giving advice to clients, but sometimes people have made a decision. They know what they've done. And when people meet me for the first time, I don't know what homework they've done all of that time. They could have other professionals in their life. They could have a whole range of things. And so just asking that question up front, what is it that you're asking me to do here, all right, is really important. And it creates good dialogue, all right? So, and if the client says, no, I actually want your opinion, I want your advice, then I deliberately go down that path of saying, all right, well, let's catch up and do that properly before we go down the mortgage broking path, or to an extent. So it is a little bit tricky, and I've had to sort of work through that and be really deliberate, because as a mortgage broker, if somebody comes to me and just wants mortgage brokering advice, I have to almost, well, we call it scoping it out. So I have to say, look, please hear that I'm not putting you through a financial planning process here. So does that make sense? Yeah. So because you just can't have that as a loose end and then not expect it to backfire at some point. But what I've learned is that not everyone wants that process. Not everyone wants you to give them advice. They've already made their decisions, and you just need to let them go on that journey.
Sure.
Guys, thank you so much for coming. I really appreciate having you guys here today, and for everything that you've spoken and discussed.
You're welcome.
As always, at Help My Wealth, we're all about empowering your financial journey, and we hope we've done that today through discussing investment property journey and talking about all the implications around that.
Thank you, Steve.
Yeah, thanks.
That's great. Okay, thank you, and we'll see you again. Bye.
Bye.
The information discussed by the Help My Wealth and the Money Rules podcast is for education and entertainment purposes only, and is general in nature, and it is not advice. It is not intended as a substitute for professional finance, legal or tax advice. It is aimed to provide a general understanding of each topic and should not be relied upon to make an investment or financial decision. It is strongly suggested that you seek professional advice regarding your own individual circumstances before making a financial decision. Help My Wealth and the hosts of the Money Rules and Money Rules podcast are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. In the spirit of reconciliation, Help My Wealth and the Money Rules or Money Rules podcasts acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to past, present and emerging elders. We extend that respect to all Aboriginal and Torres Strait Islander people today.